Let's talk about two names that have been everywhere lately, Eli Lilly and Novo Nordisk. You've probably heard of them because of the new wave of weight loss drugs that have taken the world by storm. These medicines are changing not only healthcare but also Wall Street. On the surface, both companies might look like they're in the same boat. Their shares have dropped sharply in recent months, Novo Nordisk down more than 60% from its highs, and Eli Lilly down about 25%. That kind of slide might tempt people to think both stocks are bargains right now. But when you dig deeper into the numbers, the story looks very different. Eli Lilly brings in about 20% of its revenue from weight loss drugs, but it's also more diversified. It has big businesses in immunology and oncology. In fact, its revenue split looks fairly balanced. Diabetes drugs make up half, obesity about 20%, oncology 15%, and smaller slices from immunology and neuroscience. Having multiple segments means Lilly is less dependent on one single blockbuster. Novo Nordisk, on the other hand, is much more concentrated. Nearly 3/4 of its business comes from diabetes, with about 19% tied to obesity drugs like Wegovy. Rare disease treatments make up a small fraction. This makes Novo very strong in its specialty, but also less spread out than Lilly. So at first glance, Lilly looks safer because it has more legs to stand on, but valuation tells a different story. Several factors knocked both stocks down. First, uncertainty about how effective these drugs really are. Novo's new candidate, CagriSema, fell short of expectations in weight loss results, while Lilly's oral drug underperformed Novo's. Every time new trial results come out, one stock surges while the other sinks. It's a tug of war investors have been watching closely. Second, competition is heating up. Big names like Roche are moving forward with their own obesity treatments. Their CT-388 drug is already showing nearly 19% average weight loss in just 24 weeks. On top of that, consumer-facing health companies such as Hims and Hers are finding ways to sell generic versions of GLP-1 treatments where patents are expiring. This means the market could be far more crowded in just a few years. And that brings us to the third issue, patents. Novo's patents for Wegovy are solid in the US and Europe until 2031, but in markets like Canada and China, protection could fade as soon as 2026. That opens the door for cheaper generic rivals. Lilly, meanwhile, has patents stretching out to at least 2039 in the US, a much longer window of exclusivity, but Novo may have a wild card up its sleeve. It's testing whether its existing drug, semaglutide, could also treat Alzheimer's disease. If successful, that would open an entirely new multi-billion-dollar market, one with almost no effective treatments today. Finally, politics have added fuel to the fire. Talk of tariffs, pressure on drug pricing, and new trade measures have weighed on pharmaceutical stocks across the board. Even strong companies like Lilly and Novo can't escape that kind of uncertainty. This is where things get interesting. If you just look at traditional metrics, Novo appears cheaper, but let's dig into what each company needs to achieve to justify its current stock price. For Eli Lilly, with a market cap over $600 billion, the math shows it needs to keep growing revenues at around 18% a year from 2026 to 2032 to be fairly valued right now. That's ambitious. For Novo Nordisk, valued at about $241 billion, the bar is far lower. It only needs to grow at about 1% a year after 2025 to justify its price. That's a huge difference, and it suggests Lilly's stock price already assumes a lot of future success, while Novo's does not. When analysts factor in realistic growth rates, things like a 25% market growth for obesity drugs, 12% for diabetes, and 16% for oncology, Eli Lilly's business as a whole might grow around 16% annually. Impressive, yes, but still leaving the stock about 10% overvalued at current levels. Novo, even with conservative assumptions, could grow 11% annually and looks undervalued by as much as 77%. That's a staggering potential upside. In other words, the market has punished Novo much more than the fundamentals suggest. The story isn't just about numbers, it's also about perception. Investors tend to chase momentum. Right now, Eli Lilly has become the poster child for weight loss drugs, and that hype has lifted its valuation to sky-high levels. Novo Nordisk, meanwhile, has been overlooked after a string of disappointments and heavier losses in its stock price. But sometimes, the best opportunities lie in the company that looks a little bruised. Novo still controls a massive portion of the diabetes drug market, a business that is steady, growing growing and unlikely to disappear. Add to that its obesity drug Wegovy, which remains in strong demand despite setbacks, and its ongoing Alzheimer's trial, and you have a company that could surprise investors in the coming years. So here's the bottom line. Novo Nordisk looks like a strong buy with a realistic shot at big upside if markets recognize its true value. Eli Lilly remains a high-quality company, but its stock price has already priced in much of its future growth. At current levels, it's more of a hold. Waiting for a dip could make it attractive again, but right now, Novo offers the better risk-reward balance. Both companies are leaders in an industry that is only going to grow as the world grapples with obesity and chronic diseases. But if you're looking at where the smarter money may be going today, the numbers point to Novo Nordisk.